Dan, Toys R Us is one of those stories, kind of like Sears. It just keeps coming back. It doesn't seem to go away.
Well, here's the problem. So Toys R Us is a lost example. The company declared bankruptcy, and when it declared bankruptcy, it had every intention of coming back under a restructuring, and it wasn't able to work that out with its debt holders, and that put it in a position where it had to close all its stores, give up its retail portfolio, miss an entire holiday season. For the most part, it had kiosks and some Kroger stores. And now, in the US at least, it's starting from scratch. And that is a very difficult position to be in, even if the company no longer has that sort of looming debt that was sort of crushing everything it was trying to do.
Before we get into some of the more recent developments with this company, it's probably worth giving a little bit of a history lesson with how we got there. You alluded to this, but a lot of the current situation that we see with Toys R Us is kind of the result of some of the leverage buyout action that the company went through when it went from being a publicly traded company to a private company some years back.
So let's explain what a leverage buyout is. A leverage buyout is when a company buys another company, mostly using the company that they're buying to fund the deal. So Toys R Us took on, I believe the number was $6 billion worth of debt, though it's been a while, I don't remember that exactly. So in doing that, they entered a market where toy sales were slowing, they were going online, there was more competition from big box retailers, and instead of being able to pivot and redo their stores and move to an omni-channel model and make the stores interactive and add all sorts of fun stuff that kept Toys R Us sort of at the head of the pack when it comes to toy stores, they did not have the money to do that because all their money went into debt servicing, and it created a situation where the chain got old very quickly, and it wasn't forced out of business because there was no demand for toys. It was forced out of business because it sort of couldn't keep pace with where the market was going and make its debt payments.
That's one of the major criticisms that people have of these LBOs. And the company behind this one, KKR, is one of the most famous firms for this strategy. Anyone that has seen or read Barbarians at the Gate is familiar with this firm. But yeah, it creates a lot of operational problems for the company that has been acquired because you are saddled with debt and really can't do a lot of the investments that you'd like to be able to put into your business to make sure that you're keeping pace with the trends in your industry.
It only makes sense in a market where there's incredible growth. And this one happened sort of at the sweet spot for a bad time. The industry had been growing, but Amazon hadn't quite stepped up yet. So almost the second this deal closed, all of a sudden Toys R Us was faced with this sort of massive new competition. And the presence of Amazon actually forced Target and Walmart to lower prices for toys because toys became a draw to their stores. So they weren't going to make the same margin that Toys R Us needed to make on what was kind of their only product.